Okay, ladies and gentlemen, if I can have your attention, please, we're going to get going. I'm sorry for a brief delay. I want to first of all welcome all of you here to the Aspen Institute and to this session on capital investment. I want to begin by thanking the sponsors of this program and the underlying paper which we're releasing today, the American Council for Capital Formation, the Dover Corporation, Madison Industries, the National Association of Manufacturers, Parker Hannifin Corporation, and Snap-on Corporation. So our topic today is capital investment. And despite record cash flow on the books, high profits, and consistently positive cash flow, capital investment is weak in the United States. In the first quarter of 2015, business fixed investment contracted by 23%. But as this chart shows, and this chart is in our study, this is a problem that dates back at least to the year 2000, the popping of the dot-com boom, the dot-com bubble. And this shows the typical sort of sawtooth pattern of recessions and recoveries to new peaks, but that pattern ended somewhere around the year 2000, and you have a severe decline. These numbers are net investment, so we've subtracted depreciation into these numbers. And the next chart shows us even more drastically. This is the net investment over certain periods, and you can see that it peaked 1994 to 2000, was strong before then, but just has fallen off the cliff since then. I would note that public sector investment in infrastructure and basic research is also lagging, remains 13% below the year 2007, the previous peak, even when depreciation is not taken into account. This weakness is something of a puzzle, but it's important to explore the reasons for it, given the importance of capital investment to economic and productivity growth, and hence in growth in standards of living, which Don Norman, one of our panelists and my co-author, is going to explain in a little bit more detail in a minute. Various explanations have been offered for this phenomenon, the most interesting and controversial of these being the theory of secular stagnation, which holds that little investment is to be expected because of weak labor and demographic factors and a form of technological saturation. We reject this notion, which is similar to one advanced in the wake of the Great Depression 70 years ago. Strong global markets and immigration dynamics can help to offset slow population growth in the U.S., and the notion that technological breakthroughs are unlikely seems wrong in an age of robotics, 3D printing, biotechnology, and the Internet of Everything. So our paper explores several reasons for the weakness in investment over the last 15 years and notes a number of confluent developments dating back to the end of the 1990s. In several areas, it's not necessarily that the United States has turned the wrong corner, but rather that other nations have more aggressively taken steps to strengthen their own competitiveness and have sapped global market share and investment at the relative expense of the United States. Tax policy is the most obvious and probably most important area that fits this pattern. The U.S. now has the highest or the second highest corporate tax burden in the industrial world, including effective rates, as other nations have systematically lowered their corporate rates. Regulatory policy has accelerated in the United States, while some other nations have been more restrained in imposing new regulations. In the U.S. manufacturing sector, according to a recent study commissioned by MAPI, our co-sponsor of this program, major regulation has grown at the compound annual rate of 7.6% since 1998, compared to only 2.2% average GDP growth. Related to the growth of regulation is the growth of macropolitical and macroeconomic uncertainty. New research at Stanford and the University of Chicago economics centers and business schools increasingly shows a good correlation between uncertainty due to growth in the size of government, taxes, political polarization, and regulation, and weak economic performance, including capital investment. Related to this is a significant decline in new business formation and some weakness in venture capital funding. Another major area we explore to explain this problem is loss of global market share by the United States, especially for manufactured goods. The U.S. share of global exports has dropped from around 14 or 15% in the year 2000 to around 9% in 2012, due in part to the aggressive expansion of new entrants to the market such as China, India, and Mexico. Mexico, Europe, and others have also outpaced the U.S. in trade opening agreements in the last decade or two. This certainly undermines domestic investment, including foreign direct investment in the United States. In 1999, the U.S. enjoyed a 39% market share in global foreign direct investment, but this number was down to 17% in recent years. The final area we explore is declining government investment in basic research and infrastructure, especially when viewed on a net basis. Net government investment remains at levels below those in the 1990s. The major policy recommendations we suggest follow from this analysis. Positive action, we believe, could help reverse the negative trend in capital investment, although it will require sustained effort over many years. Our major recommendations include reducing corporate rates to levels competitive with global norms or much even lower than global norms, adapting permanent accelerated depreciation or full expensing of capital investment, maintaining parity in taxation between corporations and pass-through firms, and reform of the double taxation of profits. Second, reduce or reverse the growth rate of regulation with better use of oversight measures and realistic cost-benefit analysis. We also urge reliance on state and local regulation where possible. Address problems of uncertainty with stability in governance, including regulatory, fiscal, tax, and monetary policy is our third recommendation, probably the hardest to achieve, but nonetheless we should strive for that. Fourth, pass major trade agreements to open growing foreign markets to the United States suppliers while aggressively enforcing existing trade agreements, including those policies related to non-tariff barriers to trade. And finally, rejuvenate federal and state efforts to improve physical infrastructure and its commitment to robust funding of basic research. Fortunately, we have a distinguished panel of CEOs and researchers who face the world. And I'd like to turn this over to the panel. I'd like to introduce, first of all, our moderator, Nelson Schwartz. Nelson has covered the economy and economics for the business section of the New York Times since August 2012. He's worked for a number of other publications covering Wall Street, covering international economics. He's a graduate of the University of Chicago, where he studied Russian and American history. Then in alphabetical order, Larry Gies, just to my left, is the president and CEO of Madison Industries, a corporation he founded in 1994 to focus on the operation and growth of manufacturing and service concerns throughout the world. His motto is invest and hold, and he's in a number of important industries: heat transfer, industrial equipment, filtration, and many others. Larry also serves as the president of the Gies Family Foundation, which focuses on youth education and health, and is a featured speaker and teacher at Northwestern and the University of Illinois, from which he is a graduate of the University of Illinois and Northwestern. Another U of I person, Neal Keating, is the chairman, president, and CEO of Kaman Corporation. He joined the company in September of 2007. He's had a long and distinguished career in the manufacturing sector, including stints at Hughes Supply, GKN, Aerospace, and Augusta Westland Helicopter, Rockwell Automation, and Rockwell Collins. Neal holds a BS in electrical engineering from Illinois and an MBA from the University of Chicago. Next is my co-author, Don Norman, the Director of Economic Studies at the MAPI Foundation. Don has worked in the think tank business for 25 or 30 years. He's worked at the Federal Trade Commission and at the American Petroleum Institute prior to going to MAPI. He has a PhD in economics from UCLA. And finally, Robert Stevenson is president and CEO of Eastman Machine Company. He's the fourth generation of his family to head this business, which was founded in 1888 in Buffalo and still is primarily located in Buffalo. The company sells worldwide and currently has customers in over 150 countries. Eastman manufactures a range of fabric cutting and material handling machinery. Mr. Stevenson is a graduate of St. Paul's and Yale University and is a 1975 graduate of the Harvard Business School Certificate Program. He's also very active in civic affairs. So Nelson, I'll turn it over to you. Thank you very much.
Great, thank you, and thank you for putting together such a terrific paper, which I think I've covered this subject since I started covering economics for the Times 3 years ago, because I think manufacturing is such a key part of our economy, even though people always say it only employs about 11-12% of workers. The multiplier effect of manufacturing jobs is much greater than in other sectors, and that is something that people really shouldn't lose sight of, and it's why it's really fundamental for our overall economy to have a healthy manufacturing sector. I just wanted to start with Don. In terms of the factors that you enumerated in your paper, of those, was there one that really stood out more than the others? I mean, I think everyone would agree that tax policy is important, animal spirits are important, regulation. I tend to agree with you that there's sort of the Gordon hypothesis that it sort of reminds you of everything that was invented has already been invented, which they said around 1900. So I'll put that on the back burner. Of the other factors, was there one that stood out for you guys putting the paper together that more than the others that sort of inhibited investment, which, as you made clear, has been inhibited?
Well, we enumerate a number of factors that have really provided headwinds for investment. Mm-hmm. But what we were particularly interested in were those factors that we can do something about.
Right.
I mean, if we don't buy into the secular stagnation thesis, but I mean, if that were the case, policy-wise, there wouldn't be a whole lot you could do about it.
Right.
So the things that really stood out for us were those factors that policy conceivably could do something about. Mm-hmm. So it really comes down to three things. Mm-hmm. Corporate tax policy, the burden of regulations, the burden of an ever-increasing number of regulations, and the cost that it imposes on companies, as well as uncertainty. And then finally, trade policy and the negotiation of some type of free trade agreement. So those stood out basically because we have the ability to do something about it. Whether we can accomplish anything, of course, it's another question. If it were easy, it would have been done.
Right, right. Well, besides those kind of headwinds, one issue that I've been writing about and that we were just talking about before we came in here was sort of the impact that Wall Street and the public markets has on money for R&D and investment in publicly traded companies, and that there's tremendous pressure to boost margins, to buy back stock, and to do all sorts of things with the cash you have except invest in new production and new equipment and that kind of thing, and particularly because if you buy back stock, you get a lift from that right away, whereas if you build a new factory, a new plant, that takes years, and who knows if the CEO who's there now will even be there when that plant opens up. I thought we have a really great panel to sort of provide views on both these sort of broader economic headwinds as well as the business landscape that companies face, just because Robert is a family-owned fourth-generation company, as you heard. Neal is CEO of a publicly traded company, so that gives us the public markets. And Larry is, it's a private company that invests, but unlike private equity and many companies like that, is a buy and hold, invest for the long term. Although, as you said, you have no desire right now to be public. So obviously, being private gives you some advantages. So, Neal, why don't we start with you? Talk about the pressures of being a public company and why a CEO of a public company cannot approach investing, particularly long-term capital investments, maybe the way some privately owned companies that have a quarter-to-quarter, don't have to worry about the quarter-to-quarter pressures.
I'd start by saying I don't think that the short-term pressure from shareholders in Wall Street is anything new. I think it changes in character somewhat, and we go through some phases. So I've always believed through my career that the role of management is to be able to balance the short term and the long term, and certainly at Kaman, that's what we hope to do, and in my career at Rockwell, that's what we hope to do as well. So I think we have to take a step back and say the pressure for performance is always there. I do think that the degree of it has accelerated in recent years, and it's been driven by a couple factors. Certainly, there have been a number of companies that have historically underperformed and have needed an intervention, and that has attracted activist investors. Interventions have happened, and in some cases, the trajectory of those companies has changed. In others, it has now become where they target even well-performing companies and to try and drive an increased allocation of cash back to the shareholders. And that's typically done through increasing dividends and through stock buybacks. And that does compromise the cash flow that's available for reinvestment, whether it's in R&D, facilities, or new equipment. And I think that's a real impact for a number of companies today. And it's something that we need to look at. You talked about animal spirits. There was a period of time where people looked at private equity and said, well, what is private equity doing? Well, they went in, and I kind of equate them in some respects to the animal spirits. They went in with good operating people. They invested capital into companies to improve them at a rate that those companies couldn't do it their own. So I think that we're in a cycle right now where this focus on return of cash to shareholders, which is being done in some cases at the expense of reinvestment, is very negative for our environment.
And just speak briefly, you mentioned investors. What about activist investors in particular? I mean, you always, whether you're Fidelity or, BlackRock, you want the stocks to do well. You want the companies to sort of outperform the S&P. We know that, but the activists seem to have a different sort of time horizon and sort of a different kind of pressure.
They do. They have a very different time horizon. I think that you outlined it very well earlier in your article on Timken.
Yep.
Here's a company that went in a very short period of time, was able to drive the stock price from about, you know it exactly, but $40 up to a 70.
Yep.
And now they don't own any of Timken stock. One company has done relatively well as they split the company, and the other has really struggled and probably will struggle. And that will result in likely job losses and less reinvestment because they just don't generate. Those two companies together had a very consistent cash flow profile so that you could invest over a cycle. And now separate into a steel company and into a bearing company, they don't have that consistent cash flow. They're both very cyclical, and that's going to impact their ability to invest over the long term.
Yeah, I would just add one story that's on my radar to do is about DuPont, which again is a very successful chemical company. Also, actually even 100 years older than your company, Robert, going back to the end of the 18th century, and it has outperformed the market, so it's not a laggard like the activists used to go after. But the Nelson Peltz and other activists are saying they should do even better. They're trying to press them for a breakup of the company. That's underway now. And actually the other big American chemical company is Dow, also under pressure from activists. And their European competitors like Rhone-Poulenc or the big German chemical companies don't have to deal with that. So again, that puts us on a disadvantage as a country. But so that's the sort of the public company perspective. Robert, And you're CEO of a family company, so you don't have to. You're the boss, and your family. What are the biggest challenges, or the biggest, kind of headwinds, or what reason would you hesitate to invest more aggressively right now in capital, given that it's sort of up to you and the bank?
As one of actually the smallest company here, and probably representing the majority of American manufacturers in this country, we have to be very careful with our allocation of capital. I mean, it comes from earnings, and it comes from their ability to leverage our assets with bank loans. And as a result, you're always going to be saying, where do we get the best return for an investment, and where's our growth? We export about 60% of our product is exported, and a lot of it goes into the Far East. And a number of years ago, we were facing increasing competition from the Chinese who were knocking off our machines. I know you did an article about it, how the Eastman machine was being called the Westman machine in China. And they take your trade names, and they have no shame in it. And unfortunately, in order to fight that as a small company, we just don't have the resources to fight it. So we thought, well, if we can't beat them in the US, we'll join them in China. So we opened up our own factory in China. And it's been fairly successful, but that's an allocation of capital that didn't go into the US. It went into China. And we're increasingly, with a strong dollar, it's the same situation. I mean, we depend upon exports, and if we're going to expend money or invest it, we're certainly looking overseas rather than domestically. Not that we ignore our domestic facility, because we want to make sure that we keep our manufacturing capability equal to what our domestic demand for our product is. And we're actually seeing a pretty good demand. I mean, one of our co-hosts, Kaman Company, is a customer of ours. I told him, I said he needs to upgrade. It's been a while since he bought it, but we're seeing an increase interest in automating in the U.S. market, which would certainly make sense. One of the concerns, there's a couple of things that happen. We've talked about it. One is, we're a union shop, and we're happily a union shop. We have a good relationship with UAW, but we find it increasingly difficult to get people who want to work in a manufacturing environment, as opposed to in some of the less developed countries, certainly in China, and we've talked about it in Mexico, that people are eager to work in a factory environment. And so that gives us doubts to say, do we want to continue to expand our U.S. operation, or do we want to continue to expand our Chinese operations? Secondly, the strong dollar, as you wrote in that article about us, while it certainly affects it, I'm not a believer in a strong dollar. I think for most companies, and a lot of companies in Western New York, depend upon exports. It's a huge business for them, and it hurts. When you all of a sudden you're competitively knocked out of the box, not because we can't produce it at the price, just because of the artificial value of the dollar. And the third thing is, in a way, is trade policy. I'm all for free trade as long as it's equal on both sides. And for example, our manual machines, which we still make thousands of them, and the market would be China, there's a 37% tariff on those going into China. So we had no choice but to operate in China in order to avoid that. Now, if it had been an equal playing field, I think we could have manufactured those in the United States and been fairly successful in doing so.
Interesting. Larry, from your perspective as privately held, but you have a lot of veterans who worked in publicly traded companies, as well as holding a lot of different manufacturing companies and being very skilled operators of those. What would you say are what do you think is inhibiting investment, as we saw in the charts, and what has your experience been in this area in terms of getting those companies to be as competitive as they can?
Well, I thought the white paper was spot on. I mean, it was an excellent paper, and it hit the major issues. And I think you have really two questions there. The one on capital allocation, I think everyone's kind of touched on that. It's very difficult now if you're a public company and thinking about capital allocation. As a CEO, you may only be there for 2 or 3, 4 more years, and there is a lot of short-term pressure. And I agree with what Neal said, is that I think that pressure's always been there, but the velocity of that pressure and the magnitude of that pressure is so much more than it used to be. I mean, basically, if you have capital to invest, you have 6 options, right? You can invest in your business, which is great, and that's what we're here to talk about today. but there's some other things you can do, right? You can reduce your debt, which most people aren't doing today because debt is so inexpensive. And so most people are loading up with more debt, which causes them to have more cash. You can pay a dividend. You can do M&A, do a merger and acquisition. You can buy back your own stock, or you can sit on the cash. And sitting on cash is not a good option today, right? Because sitting on cash at 20 basis points will take you a couple hundred years to double your money, right? Not a good idea. But you look at some of the other options that are out there, and I mentioned debt being one of them. People are issuing debt today. It's so cheap. They can issue very long-term debt, take that cash, then it compounds the problem. And this gets into tax policy also. There's $2 trillion of cash on large corporates' balance sheets right now. A lot of that is overseas. And if you actually look at the number, you'd be shocked at how much of that's sitting overseas. People aren't going to bring that back and invest in the United States because they're going to be investing 60 cents on the dollar as opposed to dollar for dollar. So that's not a good option. The right option, right, is to invest in the companies, and that's why we've stayed private. And as you said, Nelson, most of our CEOs in our group were public company guys, and they love operating our atmosphere because they can look at 2, 3, 4, 5 years down the line, which is fantastic. But as a public company, what do you see today? You see a lot of M&A, and you see a lot of stock buybacks. And 2015 will go down on record for stock buybacks and M&A. I mean, all-time records. And it's probably the worst time to do it. M&A is very expensive. The M&A market is extremely frothy. We were talking about it before the panel started. It's about a third higher than where it was 4 or 5 years ago. And then stock buybacks. Most pundits will tell you that stocks are overvalued today or at a very high valuation. So it's a very poor allocation of capital and very short-sighted. But when you buy back that stock, it immediately gives you an effect, right? Because your earnings per share, just simple math, are going to go up. Couple that with M&A, you do a nice splashy M&A deal, again, it's going to get the attention of the street. And that short-sightedness, I think, is what's going to cause some issues moving forward.
Here's a question for you. I mean, Don and Tom laid out sort of some of the public policy aspects in the paper that could be, the things you can actually change and affect from that standpoint. Public policy here in Washington, we have an election coming up. Hopefully, they'll keep manufacturing in mind when the new administration, new Congress comes in a couple of years. All that said, even if all that changed and some of the tax policies and some of this were addressed, that wouldn't change the Wall Street sort of pressures, the activist pressures, the short term. What do you do about that? I mean, no one favors regulating Wall Street. I mean, no one favors more regulations, more SEC restrictions. So that's out. How do CEOs, what can be done to address that? Because that sounds like a very powerful force.
Great question. I didn't think we'd get into that today, but that's an awesome question.
Yeah.
So there was probably, in the year 2000, almost 9,000 public companies. Today there's just a little over 5,000, right? And there's probably 10,000 mutual funds. So you start looking at the math, the pool of public companies is shrinking. If you look at what's gone public just over the last 18 months, 70% of what's gone public has been tech or healthcare. So I think a lot of people are making and most of those are not profitable. I mean, this is, when I say healthcare, this is like pharma. Some of the companies are excellent businesses, but many of them, they're not proven yet. On the tech side, many of them are not making money yet. Companies that are making money, companies that have a choice, even if you look at the VC community, the VC community is telling their investment, the managers of their investments, stay out of the public realm as long as you can. So I think people are making that choice today. But to your point, even if we change a lot of these policies, I don't know that you're going to see a sea change.
Interesting.
From that standpoint.
I never thought I'd say this, having lived through and covered the 2000 bubble, but it sounds like it's almost easier to not make money and be a public company than to make money, in the sense of if you're not making money but you have huge possibilities like a biotech or a tech, there's no pressure. But if you're actually making money, then people want you to give that back to shareholders. I mean,
Jeff Bezos has done a fabulous job of continuing to tell his investors that, hey, we're investing, we're gaining scale, we're gaining mass, et cetera, and still they're not making the type of money they should,
right?
Or they said they would, and they probably do 60 million transactions a day or some crazy number like that. So they have amazing share, but they're not really profitable.
Neal, how do you as the CEO of a public company, balance these pressures? I mean, you can't ignore it. At the same time, you really, you're in an industry, aerospace, that requires investment for the long term, or you could cut all your R&D, cut all your investment, your profits would go up for a year or two, and then that would be that. How do you balance that short and long-term pressure as a CEO and answering to a board and investors and all that?
You have to do it in a couple different ways. One is that, in our aerospace business or our industrial business, it really does demand that we're continually reinvesting in facilities and equipment and research and development. 2009 was horrible for almost every business in the United States, and we actually added a third to our engineering workforce in that year because we knew that we needed to be prepared for the Airbus A350 aircraft and the Gulfstream G650 business aircraft. If we weren't making those investments then, we weren't going to be ready to support those aircraft in early flight test in 2012, 13, 14. So we recognized that we needed to make that investment in people. We also knew that we had to be able to demonstrate improve profitability. And you're actually able to do that through investment. In our businesses, you're able to buy new equipment and put it in place and perhaps increase your output off of that machine tool or cutting machine by 20% in the same footprint with lower scrap. And so we actually did accelerate our capital investment in that period of time because through productivity, we're able to get so much out of it. But what are the challenges that we face in that? The challenges that we face are regulation. Again, I would agree with what Larry said. The paper really laid them out. The cost of additional regulation has really brought back what we're able to do. We're a relatively small company at about 1.8 billion, and just two simple regulations. We won't even start with the healthcare regulation and what that has meant to us so far, and what it will mean for us potentially in 2018 and for our employees in 2018. But two relatively simple regulations: conflict minerals and the new SEC regulation on revenue recognition. I'm glad I'm an engineer, okay, because I wouldn't want to be an accountant right now. But we will spend about $2.4 million on compliance in just those two regulations alone this year. And our company has about a $60 million after-tax profit. So think about what that means as an implicit tax on a per employee basis. The other thing is that we will, our capital investment this year will be about $35 million, $37 million. Look at that as a percentage capital investment. It's a big deal for us. So there's a lot of ways that we're able to try to balance, back to your question, how do we balance investment with returns? Actually, they should go hand in hand. They should go hand in hand through increased innovation, productivity, and really what we'd like to do is to be able to employ more people, because I think for everybody up here, the key is increased demand. And that is what I think we're really losing sight of today. How could these changes in policy actually accelerate demand in the market? And that's what gets you into that virtuous cycle of reinvestment, higher number of people employed in the United States at better wages, buying our equipment, and that's really what we need to work towards.
I want to open up the discussion to some questions from the floor in one moment. I just want to ask Robert, it sounds like as a country we're investing in accountants and lawyers and marketing. We're not investing enough in basic capital equipment, machinery, training for workers like yours. Your company's been around the longest of the group here, and you're going to hopefully hand it off one day to your son and keep it in your family. Are you optimistic for the future about staying in Buffalo and remaining, investors and that, or are you sort of more pessimistic? I'm kind of curious.
No,
You guys have survived world wars, depressions, et cetera.
I'm a big believer in my hometown of Buffalo. We have a good renaissance, but I am concerned about skilled labor, and I serve on the Federal Reserve Upstate Advisory Board, and all the manufacturers on that board, as well as myself, state that one of the biggest issues is acquiring and retaining skilled labor, and what to do about it. And I think we've seen a little bit of a sea change in educational environment. As I was telling you before the meeting, that one of the colleges in Buffalo State College, has opened up a technology center where they actually have manufacturing facilities to teach graduates how to operate CNC machines, how to program them, and to get in their skills. And one of the high schools is now devoting itself more to vocational, where it used to have vocational high schools.
Right.
You kind of lost that, and now they're coming back. And I think if you look at, I was telling you, if you look at a bell curve of workers, you would assume that the majority of workers in your factory would be between 35 and 55, and then they taper off as they near retirement, and you taper off of younger guys. We're an inverse bell curve. We've lost a generation of workers, and whether it's because in the 80s and the 90s, the media is saying manufacturing is dead in the United States, it's not a career to go into, when in reality, I still think it is one of the biggest drivers of our economy. And I see also manufacturing coming back into the States as we get more productivity and the ability to automate.
Yep.
There was an article in the New Yorker recently about GE opening up some very high-tech facilities and bringing in employees. And we found the same thing, that we can be competitive. We have found that in the past, the union mentality used to be one machine, one man. And as a result, you were paying somebody $20 an hour to operate one machine. And now it's, what does it take to be competitive? We said, well, if you could operate 4 machines at once, which you can do, that drives the cost down. Instead of $20 an hour, it's $5 an hour, which is it's world, that's competitive with some of the labor that you have in China. So I see one of the challenges that we have, and I'm happy to see that the educational process is changing to educate people into vocational, making it more attractive. We think it's a good career. We like Buffalo as a place. One of the things you talked about was tax policy and what can be done. We're an S corporation, and for those of you who, I'm sure most of you realize, an S corporation, you're taxed as an individual, your corporate profits. And today, with the federal taxes around 40% and New York State taxes around 6.5%, 7%, it's almost half the profits of this company are taxed, and that's an egregious burden on us. And I've stated, personally, that if you want to tax me personally at a higher rate, I believe that's fair, but if I leave money in the business for investment purposes, that ought to be at a different rate. And I think that's a policy that would help a lot of small companies achieve a better cash flow and the ability to reinvest in their facility. I think it's a big issue, and it's something that we could change. It would help a lot.
Just to follow up on the point about the workers and sort of finding workers with the skills and the training you need, especially among the younger ones as the people at the older end of the bell curve retire. Is that a factor for you or anybody else in terms of investing? I mean, I think people understand that makes it harder to find new workers, that makes it harder, but does that also, when you think about, will I invest and build a new plant, does that go into
absolutely. I mean, for example, welders are hard to come by now. And believe it or not, we do a lot of metal work. We need welders. And the thought would be, if we're going to spend money, we're going to invest money. Where do we invest it? We have a sister plant in China. We have our factory in Buffalo. And quite frankly, right now, we think we're developing the plant in China faster than we're developing our company in Buffalo, which I don't like, because I'm a firm believer that we ought to keep jobs here, but at the same time, in terms of survival and in terms of performance for the company, you have to do what's best.
Right. Well, great. I want to open up the floor to questions. You can orient them to a particular person. I'm happy to jump in if you want to elicit further answers, but please, right here.
Thank you for doing this. Excellent.
Sure.
Michael Maybach, formerly with Intel Corporation, so I was in the manufacturing business, I guess. What's the number one thing this city could do or stop doing so the Congress and the President together to help you grow business in this country?
I think the paper gave a choice of several, because it is a system problem. Being with Intel, it truly is a system problem, and you can't optimize, I don't think, any one of them without sub-optimizing the whole. But if I were to pick one where I would think that there would be at least some chance right now would be to reduce the ever-growing regulatory burden.
Don, you want to jump in from the MAPI perspective? In this town, is there one thing you guys think would, maybe break some of the logjam?
Well, if something could be done about corporate tax reform, I mean, if you look at the tax burden on American companies as opposed to their competitors abroad, you see that they're at a real disadvantage. My colleague who's out here, Dan Mextroth, recently completed a study. We summarized some of the data that he has, showing that not only do we have pretty much the highest statutory rate, but also when you look at effective tax rates, they're also high, and when you look at what other countries have done, they've been reducing their effective tax rates. We've done little in terms of that. I know there's all, it really comes down to what is the effective tax rate that you face, and somehow we're just not going to be, American companies will not be competitive in the global market as long as they face this additional tax burden. And then on top of we have the issue of this, what can you do about it? Something like expensing investment, something along that line. Somehow, we've got to make it more. You got to kind of reduce that headwind of taxation against investment.
Let me ask you just a question. I promise to come back to the floor in 1 second, but as a reporter, I hear this a lot from when CEOs come by the New York Times to cut taxes, or reduce particularly the statutory rate, the effective rate. My skepticism comes from, let's say we did that, and some of that $2 trillion could come back here. What's to say that it will be invested in the kind of things you're spotlighting versus buying back stock or other uses of capital that don't necessarily change the long-term growth trajectory? And I think the example that everyone uses is in the mid-90s, there was a tax holiday or sort of a tax remission that enabled money to come back overseas. And some of the studies have found that the bulk of it was spent on buybacks and dividends. Again, that's the privilege of companies. It's their money. I just wonder if CEOs are being, absolutely straightforward when they say, we'll invest when the past says a different story. I'm kind of curious if anybody wants to jump. One of you guys wants to jump in on that one.
For us specifically, we'd absolutely. Our companies are structured so that we have a U.S. entity and we have a foreign entity, and under that foreign entity is every foreign company that we have, except for maybe Canada and Japan. I think we're the only country out of the I'm sure we're the only country of the G7 that taxes global profits. So your concern is valid. What will it be spent on? But if it is brought back to the States, even if that company doesn't invest it, that cash is being brought back to the States for someone else to invest. If they don't have that focus or that capital allocation focus on investing in their business, it's being allocated to someone else to invest it. But $2 trillion sitting on balance sheets with the bulk of that sitting overseas is a waste. And I think to have the tax system we have today, I don't think it's appropriate to say, well, we don't know how it's going to be spent. It is a huge roadblock to money coming back to this country. That's, I think, the key.
Neal, any thoughts on whether, if you could bring that money back, whether it could be invested profitably, especially given demand, as you mentioned?
I can assure you that for our company, it would be reinvested. I think that there's clearly there's going to be a range of uses. But I think what we can be sure of is that if it remains overseas, none of it will go for domestic U.S. investment. So that's the one certainty.
And can I jump in on one point? And the white paper was spot on, but unfortunately, when you look at data, and I'm sure you guys ran into this too, all the data's in dollars. I don't know if you ran into this problem. It's hard to find unit data. But the cost of technology has taken down the cost of investment significantly. So we have an issue in this country. We do, period, end of story. But there's more investing going on than you think. For instance, industrial robots. The use of industrial robots in this country has gone up 26% in the last 3 years. And if you go to China and other countries, you'll find the same thing. But these industrial robots have, the price of them, these devices have gone in half over the last 7 or 8 years. You look at a CRM package, customer relationship management package for your sales force. I remember we'd be looking at a new Oracle package, like $20 million new system, and it has a CRM package on it. And I'd be like, oh God, what are we can we justify that? I can go to Salesforce.com, and for $800,000 across the world, my whole sales force can be in the cloud with, in my opinion, one of the best CRM modules out there. So the cost of technology, whether it's computers, injection molding machines, we had a company in Munich, Germany that made the best injection molding machines in the world, and they were getting better, but the mold technology, the hot runner systems that were used allow the output, or if you think about the capital investment per unit, to go down significantly. And that's been going on for a long time, but the last 3 to 5 years has been phenomenal as far as lowering that cost. So I do think we have a huge issue, and that's what we should be talking about, but the investment is more than maybe than we see in the numbers.
Interesting. I just want to add, whenever I go to factories as a reporter, I always ask about the machines that make the machines. And, unfortunately, a lot of the robots are made by a Japanese company, which no one's heard of here, but Fanuc.
Been through their facility.
Yeah, and then so inevitably it seems like these robots and machines are inevitably from Japan or Switzerland or Germany or Austria, which is unfortunate again for American growth, because that's where the value added is. Hopefully that maybe that'll change with 3D printing and other stuff that we are investing. Jeff, you had you had a question.
Hi, and I guess this is primarily to Dawn. Dawn, I'd be somewhat interested in your take on the secular stagnation. I know that the paper, it's beyond the scope to even kind of define it, but the Gordon story is really not what I think is secular stagnation, and it's mostly just pessimism over aggregate supply over the long term. You mentioned the variation of Summers and Krugman, and I think by his most recent writings, Bernanke as well. Their view of secular stagnation is more of an aggregate demand story. And it's basically that given low inflation, the real interest rates are too high for aggregate demand to expand. And I think furthermore that that's really consistent with a lot of the things we heard today about demand, pricing power, the power of the dollar, exports. All these things are much more of that aggregate demand point. And I think, and in the end, I think if it was to change your paper, it would put the infrastructure, the need for infrastructure at the top of the list, because it not only helps aggregate supply over the long run, but aggregate demand in the short run.
Well, we actually talk about infrastructure, and investment in infrastructure is something that really should be considered, because that does address that very issue. There is some discussion along that line. And I know that Gordon and others do talk about, whether there's sufficient demand, and Brad DeLong, others. But nonetheless, if you look at the writings of Gordon, he's talking about what drove investment in the past. And he goes through the whole sequence: railroads, automobiles, electricity, television and communications, the internet, and he's just saying that there's not something out there that's going to really attract a lot of investment. And yeah, then you can throw in on the other side the demand problems. Does that create a problem on the demand side? Yeah, I think that is part of the story, but I don't think it's the whole story. And I think that again, the infrastructure issue is a legitimate way of approaching that, because a lot of people have, are the opinion that the infrastructure is falling apart, and that might, if the government's going to invest in something, make it, excuse the pun, concrete.
Having taken Amtrak down to Washington from New York, I can vouch for your point about crumbling infrastructure and the need for investment. Let me right there. Yeah.
Hi, I'm Robert Schroeder, President of International Investor. Thanks to Aspen for this. Very good, an excellent idea for a study. And I appreciate also the diversity represented on the panel here. But let me ask about one thing that might be missing, and that is, I imagine all of you are born here in the United States. What we notice is a pattern with these 5,000 public companies that you're talking about, increasingly of boards of directors that are being asked to internationalize, bring into the boards those who represent other nations, particularly when they're interested in marketing to those other nations. How do you think that might start to change the complexion of decision making in the future? And let me add to that too, we're also seeing that same pattern. We think a new wave is coming of shareholder ownership in a lot of American companies from abroad.
Neal, let me ask you, as CEO of a public company as well as someone who answers to a board.
Yeah, I guess I'd answer it in a couple different ways. I was actually the reverse of that. I was hired to run the aerospace business of a FTSE 100 company and named to the board of GKN because the U.S. aerospace industry was clearly the largest in the world, and they wanted to have what they thought at the time at least was a better insight into that. For us, we do look at that today, and it's a discussion in our boardroom, primarily around where we think the major markets in the future or emerging markets are for us today. India is a huge potential for aerospace today. We've recently opened a facility in India, and we are contemplating whether or not it makes sense for us to have an Indian representative on our board, or, for example, Europe, another large market. We think about it, we've discussed it, and I've been a part of it, but I see that more in a perhaps retail area, not as concentrated an industry as aerospace, because it is a very global market for us, denominated typically in dollars, traditionally the same product, sold with a few nuances perhaps around the world, but more consistency. So we would look at it to get a better perspective of the local market and any of those nuances or any regulatory barriers that we might face there, and to have a better insight into it there.
You know, let me add to that. As you know, I don't answer to a board. I answer to myself, which is good and bad. But we've also seen India as a matter of fact. I have an Indian our manager in Buffalo this week, and what we've done in terms of trying to market overseas is to create subsidiaries in which we allow the local guy to have a small equity position, and we basically rely on them to manage it, and we rely on them to make the decisions for the local markets. And I think that's an important decision that we've made, that we don't try to put American values or American methods into local markets. We want to adopt what works in that country, whether it's in the People's Republic of China, where we have an outfit, or in Hong Kong, or in Vietnam, or in India, or Korea, and also in Europe. And we've been exporting since the 1890s, and I think we're very attuned to cultural differences and the different ways of doing business, and try to avoid the sort of ugly American syndrome where, you know, let's make a decision tomorrow, come on, can't you guys figure it out? We're patient. I think, you know, you have to be in dealing with overseas markets. They don't mature as fast as maybe the American market would mature. So if you have that sort of longer term view and nurture the growth and nurture the development of the local people, you tend to be more successful.
Great. Please, right there.
Yeah, I have two quick questions. If you look at the chart on the top of page 4 about investment, it looks like actually investment is coming back to kind of historically normal levels. There was this incredible bubble or incredible growth of investment, you know, leading up to 2001, 2007, but now it seems to be coming back. Am I reading that wrong? Or it seems like maybe if we waited another 2 years, those numbers would continue to be growing in a positive way.
I would just, I'll let Don answer that. I just noticed if you look at the net non-residential, I was really struck about how much lower that is than the 2007-2000 peaks. Because remember, you had the housing bubble in there as well. And as well as I was also just struck that net equipment is pretty, you know, pretty sort of quiescent. Don, did you want to?
Well, yeah, it really fell off sharply. It is coming back, but you can't just look at the absolute number. You have to look at that number relative to some type of benchmark, cash flows, GDP growth, somehow. And you have to realize that in those earlier years, which we're just kind of creeping back up to, GDP was lower, investment was a greater share of GDP or cash flow at that time. So, and it's not surprising that we're going to get a bounce back from a, you know, really we fell off the cliff there with the Great Recession. But we're just, yeah, it's coming back. But if you look at the latest data that just came out recently, you find that net private investment in the first quarter actually dipped a bit. So I don't think by any stretch of the imagination that we're back where investment's on a healthy growth path.
I would just add, I was really struck in the paper by a chart on page 19 that showed the U.S. losing export market share, which is interesting because exports have increased. I mean, exports have been a success story, particularly in the last few years, contrary to what a lot of Americans might think. However, China, and I understand it's not a zero-sum game and that we are growing, but if you just look, China going from 4 to nearly 20%, that's got to come from somewhere. I mean, and I was just really struck by that. I was also struck that Japan, their share had actually dropped quite a bit, which may be one reason why we speak of a lost decade or decades for Japan. Any other questions? Yeah, please.
Thank you. It's Dana Marshall with the Transnational Strategy Group, and let me also congratulate Tom and his colleague on this program. One quick observation and then a question for Robert, if I may. One observation, I haven't had a chance to thoroughly look at this, but there is a community of people in Washington that think one of the answers whenever you talk about tax and competitiveness, that moves us into a possible VAT situation. I don't think you raised that. I'm not necessarily asking that you discuss that, but just wanted to observe that to me is interesting, that doesn't seem to be something that has been in this paper. Pardon me. But the question that I had for Robert is this, and it's very valuable, I think I can speak for a lot of people that are in this policy world in the Beltway, to have someone that's an actual manufacturer way outside the Beltway that understands what it's like to operate in the real world. We have TPP underway, possibility of China knocking the door at some point if that should be negotiated. We have a bilateral investment treaty that is being actively negotiated with China, India, and some other countries. You mentioned, Robert, that I don't want to overinterpret what you say, nor do I want to have you get into areas that are proprietary, but it would be very interesting, I think, to understand the way you look at this policy, these policy thrusts and what it means for your actual business. I think I heard you say you'd been exporting to China, but because of a large tariff wall, you've been forced to operate there. What's interesting also about your business is, and again, please excuse me, I'm not an expert in it, but my sense is it's a medium tech business. It may not be one that the Chinese are targeting as a matter of supreme industrial policy to dominate the world in. So you're a particularly interesting test case. If we were able to really break down tariff barriers there in some way, could you sell there without having a plant there? Would that be even feasible? Could you Could you reshore that? What's the honest observation of a manufacturer, not USTR, Treasury, State, or Commerce official, but somebody out in Buffalo on that question?
Yes, I mean, there is a demand, interestingly enough, there is a demand for USA-made products in China. They're considered to be better quality than the local manufacturers. So if there was a tariff reduction, and if there truly was a free two-way trade, we would benefit in terms of manufacturing in the U.S. On the other hand, and due to, we're also trying to sell, as the panelists mentioned, India is a burgeoning market for us. And we find that some of our competitors who are located in manufacturing in China would have a huge cost advantage if we tried to sell U.S.-made product into some of these markets. So we're forced to maintain a Chinese factory in order to be competitive price-wise. But at the same time, yes, there would be a benefit. I mean, it's not a 100% benefit, but there certainly would be a benefit for us to have equal trading. One of the things that's interesting, if I can divest a little bit, is a couple of years ago I had the opportunity to talk to Tom Friedman. He made a book called "It Used to Be Us: Success in what made American manufacturing successful," and we actually ended up being part of his book. As he said, you're not supposed to still be operating after 120 years. And he said, what is one thing that would really help? And as I said earlier, the propensity of China to sort of copy and basically disregard intellectual property or trademark has serious consequences to the small American manufacturer. And it's estimated that over the past decade, probably 2.5 million jobs were lost in smaller manufacturers who find their products copied or duplicated and sold back into this country or sold elsewhere. And I said, we can't afford, unlike Coca-Cola or Microsoft or some of the big multinationals, we can't afford to defend ourselves in China. It's impossible. And I said, if the U.S. Department of Commerce, instead of promoting all these marketing gambits in these countries and spending a lot of money, which almost come to nothing, would say, let's defend American property rights and help small companies. I think that would be very effective as well in terms of if we could affect policy in Washington to say, look, help these guys, help us that we're trying to promote American products, but it's unrealistic for us to invest a lot of money in developing it to find out it's knocked out in 6 months later by a Chinese copycat.
Interesting.
We've been very involved in China, both in technologies that the Chinese government hasn't said this is a priority, such as injection molding machines, and then technologies such as transmission systems for automobiles and telecommunication systems. And I absolutely agree with Robert. It's easy to get a judgment in China. Getting enforcement is almost impossible. The approach we've taken is we've invested heavily in China, and we just keep raising the bar. We just keep making the product better. What we found is, especially transmission systems, the Chinese government wants a Chinese-made transmission, designed, engineered, and made transmission. We have filtration technology that nobody else has. So we keep raising the bar so that we're the people that are the chosen folks for that filtration device. So we've just said, look, we're not going to wait for government to set something up or negotiate something. We just don't see that as a viable alternative. We're just going to keep on making the product better and having our engineers in China working each and every day with the automotive manufacturers over there, not just the Chinese automotive manufacturers, but the transplants. We found the same thing in telecommunications. Whereas our government has shut out the largest telecommunications provider in the world out of our country. They're very prominent in China, and we actually ship to them in China. So I do think you can do it if you have the right technology and if you invest, especially locally. I do think it can be done, but it is very difficult.
I would just add that it's interesting that the regulatory burden on Chinese companies is so much lower than on American companies. I'm not saying we race to the bottom, but like what Neal was talking about, conflict minerals. I mean, not only do many of the conflict minerals come out of China, but I just think that's the last thing they're thinking about when they're making stuff.
When we set up a plant in China, we actually run it with the same OSHA rules that we have here in the United States, above those OSHA rules. And I'm sure everyone on the panel does the same thing. But the rules and regulations are lower there.
Right.
The ability to, and you said it very well before the panel started, that the time frame to build a new facility in the United States versus Mexico, China, India is remarkable. And so you think about the return that you need to make on your investment, and time is the biggest variable there, and the way to increase your returns. So being able to get something done in 2 months or 4 months versus sometimes 9 to 15 or 18 months makes a huge difference.
You hit the nail on the head. We are trying to build a plant in a Midwestern state right now, and literally we're looking out into 2016 as, when we have the chart and all the colors, where we're behind, it's regulation. Whereas in Mexico, we made the decision 60 days ago to put something in the new automotive triangle. It's going to be up and operational about 60, 70 days. Wow. It's that fast. You go down there, the government officials come to you. You don't have to look at them, or look for them. They come to you and they say, how can we help? It is amazing how open they are to that investment. It's very easy.
It's interesting. I mean, I wonder if part of the problem is, people perceive manufacturing kind of as outdated or a dinosaur in America. I think partly because consumer products are often made overseas, and B2B is more what is manufactured here, but consumers and ordinary voters don't see those products. I also think a lot of stuff's made and manufactured in the heartland. I worry that the people, everything you are all saying is intuitive and makes sense. It's frustrating to me as an American that the people in this city don't always see that. I mean, sometimes I wonder if the regulations impacted law firms really as hard as they impacted manufacturers. Well, all of a sudden you'd see regulatory relief.
It really gets into, when I walk one of my floors in Germany, there are once a week students from the German schools coming through the facilities and looking at possibly signing up for an apprentice program. Whereas in the United States, I never see high school or college age kids coming in to look at manufacturing as an opportunity. It's a huge dichotomy.
Yeah. I'm interested. I think it's beginning to change a little bit in places like South Carolina has a big apprenticeship program, which I wrote about. I'm actually going tomorrow to Newport News to visit Huntington Ingalls Shipbuilder, which is trying to expand their apprenticeship program. So hopefully we're getting it, because our foreign competitors certainly are. Please, any more questions? Yeah, please.
Another one for Mr. Stevenson. You mentioned it was difficult to get welders in the United States. Now, but you can do it in China. What does China do to have a supply of trained welders?
I'm not sure. I just think in China, there's the whole, in a sense, revolution of people moving from the farms to industry in terms of the attractiveness of better wages, is that they're willing to learn and they're willing to do it. And I don't think it's necessary that they have a different skill set. It's just that, as I said, I think in this country, we've put off people from entering the vocational trades as if it's not a career. Matter of fact, I was telling Nelson beforehand, I had a young worker who had an attendance problem, and we finally let him go. And he told the president of our union, he says, well, I don't give a damn. He actually said a little stronger than that. There's not much of a career in working in the factory anyway. And the president of the union's been there for 37 years. He said, are you kidding? He said, I put 2 kids through college. I have a vacation home. I've had a great career here. I said, you're nuts to be giving this up. But I think we have a lot of youth who unfortunately don't look upon manufacturing or a career in sort of vocational trades as a successful pathway to a fruitful life.
Well, we in fact tell them you should go to college. I mean, if you don't go to college, it's considered a failure. And look at all the college graduates we have who either don't have the skill set or there's not a job available to them. I think we've done it ourselves.
Yeah.
I would just add, what's interesting is you guys even provide a pension to your employees, which many white-collar employers have done away with pensions. So, I mean, it's sometimes it's really the opposite of what people think.
Right.
Any other? It looks like we've got some. Yeah, please, right there.
Hi, Michelle Jamrisco from Bloomberg News. I wanted to ask about a rare bright spot that we're seeing in the CapEx data, and that is research and development funding investment. Over the past year, we've seen kind of a jump in that, and I'm wondering if you believe in that trend, or if it's still too young, considering the GDP data from the government has just started calculating this differently. Where do you see this going, and why not?
Don, you want to?
Well, just in general, if you look at R&D spending over time, that has held up generally much better than other types of investment. I know I conduct a quarterly survey at MAPI on the business outlook, and there's a question about what your plans are about R&D spending. And I've been doing this for a long time, and it was done a long time before me, and that's the one index which is the least volatile and probably over time has the highest average. For some reason, in general, companies tend to maintain their R&D expenditures over time, at least according to the survey data that we have, and as well as some of the aggregate data.
I'd break it down in a couple different ways too. I think that companies do tend to maintain R&D more consistently because it is the lifeblood. Many companies have a thing that goes by different names, but sometimes it's a vitality index. What percentage of your sales come from products introduced in the last 3 years? And that's something that is really critical to maintaining your competitive edge, so you continue to stay focused on that. So I think that might be one of the reasons. But I think then, and this is where Don could help, is if you look at the makeup of that, it's changed dramatically. If you went back 30 years ago or 35 years ago, you would see that the U.S. government funding for R&D was remarkably higher. I think it's down to about 10 or 12% of what it was 30 years ago. And now take a step back and say, what were the things that we were doing 40 years ago? And what were the implications for the growth of our country and our standard of living? There were things like, let's see, the space program. And think about everything that came out of that. Microelectronics, telecommunications, the GPS so the mails don't get lost in the car all the time now. But everything from cell phones on through. And so much of that investment came from seed money from the U.S. government. And a lot of it was for aerospace, defense, and the space program. And now you contrast that to today, where, again, I think that their investment is about 10% of what it was before. And this is the first time in history, from the time the Department of War was renamed the Department of Defense, that we do not have a new aircraft under development by the U.S. government. They're talking about long-range strike bomber. Okay, that's fine. They're talking about it. We're years from putting a pen to paper on that or starting to work on it. Now, think about what Boeing did with the 787. It's a remarkable airplane. It introduced 5 revolutionary technologies at one time, but it wasn't the smoothest birthing process. You all know that. Why? Because it had been 15 years since they built an airplane. You look at Textron. They built the Scorpion aircraft because they needed to build an aircraft or they were going to forget how to do it. So today, we are losing it, a lost generation. Engineers coming out of school today. Do you know there's as many engineers graduated in Poland, which is a wonderful country, as there are in the United States in any year? And where are they going to go to work today? There's great jobs in technology. We love that. But what about the basic R&D that's going to drive manufacturing, engineering, and manufacturing jobs in the United States? That's where we're missing a great opportunity, and it's good that we're sustaining investment, but we drive through too many factories that are empty every day. And if you think about generating demand and generating jobs for people, that's really what we needed to do. I went to work in a facility in Milwaukee, Wisconsin, out of undergraduate school. It had 5,500 employees in it. They have under 1,000 today, and they do no manufacturing. And when I went there were 4,200 manufacturing jobs. It might have been 4,300. And they're all gone. And they're still building those products. There's still demand worldwide for those products. But it's too expensive, or the regulatory burden, or other aspects of some of it's training. But it breaks my heart. I've got a 14-year-old and a 12-year-old. And I don't buy into this secular stagnation. I read that, and I go back to the head of the U.S. Patent Office in 1899 that said everything worth inventing has been invented. That's crap. And I still believe in American exceptionalism, and I am sorry if I do. But we've got the best educational system, and if we can just drive some change so that we can give our workers in our states and our kids a chance, we'll be a hell of a lot better off. Sorry.
No, thank you for that. Everything you said really touches on a lot of what we're discussing. I thought your point and the point about the paper, in terms of those huge government investing programs, beginning with the Manhattan Project and going through some of the post-Sputnik investments and then the space program, and DARPA and the internet. I mean, everybody made fun of Al Gore for, quote, inventing the internet, but the truth is the DARPA and ARPANET is the root of that, and that is sort of the most, profound economic force for change right now. It did come out of a government-funded program.
And are we at
yeah.
risk when we look at R&D? Because it's a great question, because I've noticed the same thing, but are we at risk when we mix R&D together? Because I do think there's still a lot of D, there's still a lot of development,
right. Yeah.
but to your point, the government's not funding that research, and that's the most important part, because that research is what really gets things going. It's the genesis of these new amazing technologies, but there's really no ROI, or you can't calculate an ROI. So I think that R&D, if you were to bifurcate it, I don't know this for a fact, but I bet you there's a lot more D now than there used to be, and the R has really shrunk, and that's an issue.
Yeah, no, it's very interesting too. If you look at the pharma business, big pharma like Merck's and Pfizer's have a lot of cash, a lot of money, but their pipelines are pretty weak. That's why they're buying smaller companies, but there's really a danger if companies don't invest, they end up eating their seed corn. So there's someone else I think had any other, over here, yeah.
I just got a quick question. We really haven't talked about, I'm Neal Keating from King & Spalding. We really haven't talked at all about the trade deficit. We have a $700 billion trade deficit in manufactured goods. There are loads of things we don't make here anymore. We don't make computers, we don't make smartphones, we don't make liquid crystal displays, and then at the other end we make basically nothing that's sold at Walmart. And how does that play in this? Is that just a result? Is it a cause of what we're talking about, or what? It's just seems to be an endemic, it's kind of the elephant in the room in terms of what you can invest in. Maybe not for the very sophisticated companies up here, but for loads of products that we should be making, we're just not making here anymore.
I want to open that up maybe to Don, but I just want to point out the total value of everything we manufacture has never been higher. The issue is that we make it with many fewer workers. I mean, you're right about the consumer products, but if you look at like what Boeing does, and these kind of value-added products, we're still manufacturing and exporting tons of stuff. We're doing it with a lot fewer people. But Don, you want to address his point on the trade deficit?
Well, one of the issues with the trade deficit has to do with the value added. I mean, take the example of the cell phone. I mean, yes, that's manufactured in China, but a lot of the development occurs here in the U.S., so you have a lot of value added actually taking place in the U.S. So if you look at the price of that phone, that's not all China or Taiwan or wherever. And but it is a problem. I mean, we do have a growing trade deficit, and the March report that came out yesterday shows that it bumped up again. And the consequence of that is that when the revisions come out to the first quarter GDP numbers, they're, instead of having 0.2% of growth, which was pretty abysmal, we'll probably end up with a negative rate of growth for the first quarter the next time we get a revision. So it's a problem. It certainly doesn't seem to be getting better, and there are a lot of reasons for it. I mean, one has to do with the value of the dollar, what's going on there. A lot of it has to do with, difficulty of investing here in the U.S. and, what leads companies to go abroad and invest.
We don't scale up and manufacture here in the United States. It's a great point, because we do the R&D and we do the design, and instead of scaling up here, it is so much quicker and less expensive to scale up the manufacturing someplace else. That's why that comes back in. But what we lose is we lose all of the learning of building the product. That's why we don't do LCDs here. It's why, 25 years ago, people decided that television was a mature industry, so we weren't going to build TVs anymore. We kind of missed the liquid crystal display. We kind of missed HD TV. And we missed our engineers and our technicians and our plant floor workers learning what it takes to build those products and build them better. So think about all that learning that we've lost because of those decisions.
I think manufacturing, you know, you hear about Uber and you hear about Airbnb, and they talk about the power drill. You know, if you had one power drill in every residential block and everyone shared it, it would be much better because the average power drills use like 10 minutes in its lifetime or something like that. And this sharing economy they talk about is like this new idea. Manufacturing's been in the sharing economy for 30 years. And especially in the last 10, when we look at a project, it's exactly what you said. We say, all right, we're going to design it in this spot, and we're going to manufacture it in that spot, and it's all based on the best place to do it and the lowest cost. So our filtration companies, we have 80 rooftops just in filtration around the world. We have centers of excellence. If someone can make a product very well in one spot, we'll invest in that one spot. If it happens to be in China or India or Germany, it doesn't matter. We're going to go for the best spot. But this sharing economy, using that capacity that might be available somewhere other than here, or it's easier to build a plant there than here, and it's easier to tool up there than here, we're going to do that. And so I think it's something that cannot be solved very quickly. We are incented to set up the best global supply chain we can, and oftentimes that means we don't choose the United States. And that's going to take not only the government, but a concerted effort to bring back to this country certain things that we just don't have here anymore. It's very hard to get tooling in this country. I mean, try to get tooling in this country, it's almost impossible. It's really shocking.
Any other questions? So I would just like to thank first Tom and Aspen, it's great, and Don and MAPI for the work on this. And I want to also thank before I thank the panelists, I want to thank the audience for great questions and for forming your questions in the form of a question rather than a speech. So thank you for that. And I just want to thank our audience, Robert and Neal and Larry, just great perspectives and companies that are still doing a lot of stuff here. So thank you.
Great. Thank you.